While investors panic over tariffs and a possible recession, there are some real opportunities to turn all that chaos into a nest egg. Fasten your seatbelts, folks. This is going to be a good one. With economic tensions rising between Canada and the United States, with an ongoing trade war and whispers of a global recession, smart investors, well, they're looking for safe harbors that offer both protection and maybe even a little bit of profit. In January, Hamilton released two new ETFs in their Champions line that may just fit the bill. There is the Hamilton Canadian Minimum Volatility ETF, or CMVP, and the US Minimum Volatility ETF, or SMVP. The same concept, but two flavors of ETFs that are designed to survive economic turmoil and perhaps even thrive a wee bit in all the chaos. It goes without saying that in a recession-fueled bear market, these ETFs are going to dive into the red with the rest of the market. However, with their focus on blue chip companies with lower volatility, they more than likely could very well outperform the pack. Whether or not this turns out to be the case, these ETFs, in conjunction with a dollar cost averaging or DCA strategy, have the potential to help you start grow a resilient nest egg that that comes with monthly dividends. So that's not too shabby either. CMVP, or the Canadian flavor, is designed to track the Selective Canada Dividend Elite Champions Index. In a nutshell, that means they hold an equal weighting of Canadian companies with a very long history of stable and increased dividend payments. SMVP, or the American flavor, is designed to track the Selective United States Dividend Elite Champions Index. You guessed it. That means they hold an equal weighting of American companies with a very long history of stable and increasing dividend payments. A sub to the channel gives you an equal weighting of future content. So why is dollar cost averaging the best strategy to use with these ETFs? Dollar cost averaging is an investment strategy where you consistently invest a fixed amount of money into a particular asset at regular intervals, regardless, and this is the important part, regardless of their price. This approach allows you to mitigate the risks of market timing by buying more shares when prices are low and fewer when prices are high, smoothing out the impact of volatility over time. Of course, in a down market, DCA is especially effective as it sets the stage for higher returns when those markets rebound. I do want to very briefly touch on the two flavors. Some Canadians are trying to invest more at home opposed to the US, and that is absolutely fine. CMVP will be a great option for that mindset. Also, this one does come with mostly Canadian eligible dividends. I have often said I do not like to ignore the world's largest economy to the south of the border, and if you are okay with investing in the US, then SMVP, they do have you covered. Where both of these funds are very new, we will not have the typical deep dive. So our good old buddy, Mr. Math, gets a night off. Nonetheless, we can still take a good look under the hood to see what these ETFs are made of. We'll start with CMVP. So at the time of recording, they have a current value of $15.43. Their NAV, that's coming in at $14.93. And those assets under management, $12.26 million. Keep in mind, those assets under management will grow as this ETF has a bit more time to gain in popularity. Currently, their management fee is coming in at 0%. They have waived their fee until January of 2026. Also, as this is a brand new ETF, we do not yet have a management expense ratio. So that is to be determined. Looking at their dividend, that's coming in at 3.705%, monthly dividend of 4.6 cents per share. We have a year-to-date return on investment, currently negative 3.56%. Factor in the dividends, total return 2.19%. Of course, with the market struggling as much as it has lately, these numbers are they're actually pretty good. Because this stock holds an equal weighting of the shares that it's holding, we can get a better idea of what we're getting by looking at their sector diversification breakdown. Up at the top, we got financials, 35.7%, energy, 14.9%, materials, 13.6%, industrials, 12.1%, communications 8.1%, and consumer staples 7.8%. I do like the looks of that diversification for sure. Okay, let's switch over and take a look at SMVP. So their current value at the time of recording, $15.25. Their NAV, $14.57, and their assets under management, 8.83 million. Their management fee comes in at 0%. Like CMVP, this fee has once again been waived until 2026, and we do not yet have a management expense ratio. Looking at their dividend, it is a little lower, 1.986%. It is a monthly dividend of 2.4 cents per share. On their year to date, that return on investment, negative 4.69%. Add in those dividends, total return, negative 1.69%. Once again, these are not that bad considering, the year the market's been having thus far. Okay, let's take a look at their diversification. At the top, they've got consumer staples coming in at 22.9%, industrials 19.4%, materials 12.2%, healthcare coming in at 11.8%, financials 8.8%, and technology at 6.3%. Looking at these two ETFs, I do like their general makeup for sure, but they do come with a lack of history, which for some investors, that could absolutely be a mild detractor. Of course, one point that does tend to come up is, why choose these ETFs when we have the great Vanguard combo of VFV and VDY? Well, the big difference is that the Hamilton ETFs are designed for lesser volatility, and thus they are a bit more on that defensive side. I did mention that these two ETFs were two of the Hamilton champions. Well, there are another two, and in fact, these two are, they're the enhanced versions of the two we've already looked at. So in other words, they've added 25% leverage to pump up those returns a wee bit. So CMVP has the leveraged version, CWIN, and SMVP has the leveraged version of SWIN. These two enhanced versions, they can add a lot more to your returns, but keep in mind, they come with that added risk of leverage. If you are interested in the ETFs that we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on defensive covered call ETFs. Thank you for watching, and I will see you in the next video.